I want to welcome everybody. My name is Josh Schneps. I'm the publisher of Brownstone. Our parent company is Schneps Media, and we publish a lot of the local media outlets in Brooklyn and throughout New York City and Long Island. We're thrilled to have you all here with us today, and we have a terrific group of panelists that are here to give you a lot of terrific information as well as answer your questions. Again, I had said it earlier, but just to repeat myself, feel free to ask questions throughout. We want this to be as conversational as possible. We have a full agenda of questions to ask them, but if you want to pop in the Q&A or the chat questions, feel free to do that. We'll try to get to as many of those as we can. If we can't get to all of them, we're going to be emailing all the panelists' contact information. They would love to hear from you. That's why they're here, to give you information and answer your questions. So again, if we don't get to all of them today, please feel free to reach out to them individually, as we will email you all of their information. I want to thank the panelists as well as being our sponsors, which include NestApple, Loan Depot, and attorneys at law Belkin, Burden, Goldman, LLP. And again, this afternoon is going to be really an informative session discussing advanced techniques for buying a townhouse, co-op, or condo in Brooklyn and beyond. So I think we'll start off just introducing each of the panelists. Let them introduce themselves to each of you so you know who they are, what their company is, what they specialize in. And if you don't mind, if we could start with Nicole Fishman.
Sure. Hi, everyone. Thank you for having us. I'm happy to be here. I'm Nicole Fishman. I am the head broker and co-founder of NestApple. We are a brokerage firm operating in all of New York, and we offer cashback to our clients.
Terrific. Thank you, Nicole, for being here. Michael.
Hi, good afternoon, everybody. Thanks for having me. It's a pleasure to be here. My name is Michael Champan. I am an attorney and partner at Belkin, Burden, Goldman, LLP. We are exclusively a real estate firm based in Midtown Manhattan. However, we service both the suburbs and New York City, all 5 boroughs. I specifically handle transactional real estate, meaning purchases and sales of residential and commercial properties, as well as leasing for commercial and residential properties.
Terrific. Thank you, Michael. And Eli.
Hi, thank you, Josh, for hosting this wonderful broadcast to the public, and thank you for everyone tuning in. My name is Eli Sklar. I'm a senior loan officer at Loan Depot, publicly traded mortgage bank in New York City. I specialize in residential financing for condos, co-ops, townhomes, anything that looks like a home that you're going to live in, pretty much. I finance. I don't finance leases for homes, but I finance regular mortgages. And I have a wife and 4 kids, and looking to make everyone a homeowner.
Well, that's a full house. I give you credit.
Thank you.
Well, thank you so much.
We're trying to fill it out. We're trying to fill everyone's house. You know?
I love it.
Trying to make everyone happy.
I love it. Well, Nicole, let's start with you, because I think before we start the discussion of the advanced home buying techniques, I think it'd be great for you just to give a quick overview of the real estate market right now, particularly in Brooklyn and beyond, and whether or not you feel we're in a buyer or seller's market.
Sure, my pleasure. So currently, for sure, the pandemic discount is over. There's no more COVID discount. I would say right now we are in a seller's market. Is low. There's really little good products left. Sellers are cashing out and getting above ask offers. Tenants, rents went up so much compared to the last 2 years that we have also a group of tenants who, frustrated and caught off guard by that situation, are now jumping into the market and becoming buyers. But yeah, definitely a seller's market right now.
Interesting. Very interesting how strong the market has kept up throughout this pandemic. So staying with you, Nicole, talk a little bit about what a commission rebate is and who could benefit from one.
Sure. So a commission rebate, very simply put, is money that your broker can give you or share with you at the closing table. Okay. At NestApple, it means from whatever commission I receive as your broker, I give you back 2/3 of it.
Wow.
anyone can benefit from it, any buyer. We don't limit it to any purchase price. There's no neighborhoods. There's no really prerequisite. The minute you buy with us, you get half, 2/3 of our commission back.
Wow, very interesting. So talk about what a commission structure looks like in New York City for real estate deals, and where should the cash be coming from, or does the cash rebate specifically come from?
Sure. So a typical New York deal will be like this. You have 6% is going to be the commission for the brokers, okay? And that's going to be split between buyer's broker and the seller's broker. Now, even though the commission is paid by the seller, it's important to understand that that money is included in the purchase price. So you as a buyer are going to cover those costs, okay? And then we come up with 3 possible scenarios. Scenario number 1, you have a direct buyer, no broker, the entire commission, all 6% goes to the listing agent. Done. Scenario number 2, you have a buyer working with a traditional broker, and that commission is split in half, 3% for one, 3% for the other. Then you have the smart buyers who hire NestApple, where we share our commission with you. Half of the commission is untouched, meaning the seller's agent gets their full half. From my 3%, I keep 1 and I give back 2. So our clients are making twice as much as I am, and the commission rebate only comes from our portion. We don't affect the seller's half.
Wow, that's incredible. That's really good information for people to know, to be able to save, because at the end of the day, this is probably one of the largest or the largest investment anyone's going to be making when they're buying and selling.
The biggest, yeah. It's going to be, and it's a very emotional process for people, but when you explain it so simply and people understand that there's a way for them to make money, and if they don't do it, it's just not going to go anywhere else but to someone else, it's just a no-brainer.
Ellie, I'd love to ask you a question here. How much of a down payment is required to buy, whether it's a house, condo, or co-op in Brooklyn?
It's a good question. In Brooklyn, the minimum down payment depends on generally the type of purchase price that one is buying. If a person's buying $1 million co-op, there are programs that you put down as low as 10%, sometimes even 5%. I've done 100% financing for veterans. It depends on their qualifications and what one is able to do. But there's usually restrictions when it comes to New York in terms of the building itself, that even if they actually could put down 0%, the building may not allow them to buy in their building because of a higher risk that if the person doesn't have any assets for a down payment, presumably you won't have necessarily money to pay the maintenance either. So it lends a certain amount of additional risk that the building may not want. But there are programs for very high level financing for doctors and for special types of people. And there's different strokes for different folks, I like to say. So it depends. If a person's motivated and they have a certain price range that they want, then we can assess how much is needed. But generally 10% is the minimum for purchase transaction.
And maybe, Nicole, it's a question for you is, I would imagine though, in a seller's market, the less you put down may be to your disadvantage if you have another buyer that comes in with either all cash or more money down. I don't know if you could speak to that.
Yeah, sure. I mean, it's very much on a case-by-case basis. I feel like, of course, it's going to be more attractive for a seller to just get a bigger chunk of money. But when they're financing, the seller is going to get the money some way or another. So really, as long as, it's really more about getting the buyers the better deal they can get and really getting them the best products they can have. I think if you're really competing, apples to apples, and it's really gonna make or break the deal, sure, maybe putting some down will make the offer more attractive. But in the end, it's gonna be which package and which product you as a buyer is gonna get from your loan officer that's gonna make you just a better candidate and a better competitor.
So, it's also a question for you, which just came in from the audience. They're asking, how do you find brokers who share commission? So maybe, do you want to just maybe be a little bit more specific about how people can work directly with you and your company?
Yeah, for sure. So, you're going to get my contact information. I also want to, the difference between traditional brokerage firms are us, it's really the way we give back money, because everything else we do the same. Brokers share their commission with their agencies, with their brokerage firms. So that money is already split. The reason I can share the commission with my clients, number one, this is my company. Number two, it's our business model. And it's really just a way to optimize and make business just more efficient and more attractive for buyers, and giving them just better opportunities to buy better properties. So yeah, for sure, NestApple, NestApple, and you're gonna get our contact info from these guys as soon as we're done.
Good. Yeah. So hopefully, Gwen, that answered your question to us, because to be clear, she is a brokerage. So it's just the way in which that she compensates at the end of a closing is what differentiates her company.
Correct. It's just our business model and how we want to modernize the way real estate is done in New York.
Listen, it's hard for people to wrap their heads around that because they're not used to it.
But it should be the new normal. It's going to be the new normal.
Michael, question for you. What is it? When is it appropriate for someone to buy under an LLC? And what's really involved in that?
Right. So an LLC, for those who don't know, is a limited liability company. It's a business structure under which an entity of one person or multiple people or entities can own a property. I would say, just as a general overview, buying a condominium apartment, a townhouse, a house as an LLC is usually permitted. Co-ops often frown upon buying or owning as an LLC. They typically want individual owners. So if you are buying a co-op apartment, I would check, but more often than not, co-ops are not really happy about that. The benefits of ownership of an LLC, one is privacy. When you do buy a property, a house, a condo, a deed gets recorded, transfer tax documents, a mortgage, and your individual information will show up on the New York City ACRIS records. So one way to shield that is by buying under an LLC, although you will be signing the documents if you're the sole member individually, and some of those documents that you will sign at closing include your personal name and your social security number. Those documents are not made public. So if some random person were to look up the records for a specific apartment or house, they wouldn't see your name individually. Another benefit of an LLC is it shields your assets. So if if you have a tenant or somebody's visiting your property and they were to slip and fall, for example, and want to sue you, the owner, if you have an LLC entity in ownership, the assets of the LLC are all that are at risk, not your individual assets, because you're not an individual owner. So it's a really great way to shield responsibility. And lastly, another benefit is there are some tax benefits as well to owning through an LLC. You know, we would of course advise speaking to your accountant or tax advisor, but you know, in New York, LLCs, the share of profits goes down to individuals, and the actual business is not taxed, just the individuals. It's called pass-through taxation. So there's benefits to that. There are a large number of deductions you can make. Once again, you know, when it comes time for that, you can speak to your accountant, but it's something to keep in mind. And one last note is that it's worth discussing with your lender at the beginning of the process whether they're open to you owning via an LLC or whether they prefer you to own individually. It's not something I would mention later on down the line. I would bring it up initially. And then quickly, as far as setting up an LLC, it's fairly simple. There are companies, if a client comes to me, I usually am able to work with an outside company who performs all the steps on their behalf, but simply you want to make sure that you come up with the name of an LLC that's not taken yet. All New York entities, LLCs usually have to have LLC or limited liability company at the end, but you can name it otherwise whatever you like. You need to appoint a registered agent who receives all notices. Typically, you could hire somebody outside. There are companies that provide that service. You need to register with the state of New York. Again, a fairly easy process. Getting an ID number, creating an operating agreement, something we could help with, which is just the business structure, the rules, the regulations of the entity. And lastly is what's called publication. It's sort of an antiquated idea, but if you start an LLC in New York, within 120 days of the effective date, you need to publish in a couple of different newspapers to bring everybody on notice as to the creation of the LLC. This is back from a time when that was the means of communication and of informing the public. Now, so not really relevant, but still, again, there are services that provide all these functions, publication, providing the EIN, checking names, and it usually runs about a couple of $1,000s for everything. And just one other note, there are running costs with registering the LLC every year. So it's just worth keeping in mind that on a yearly basis, there are some minimal costs as well.
It sounds like a lot, but it's really not complicated.
No, and there are professionals who make it really, really easy for you. So yeah.
Ellie, back to you on getting the money, the financing, the important stuff here. Talk about what a buyer needs to qualify for a mortgage.
They just need to have a heartbeat. As long as they're breathing and a heartbeat, it's
That's
they'll get
it.
a loan. That's all you need, and a good loan officer. Well, I usually call it the four legs of a table. Just like a table needs four, a regular table has four legs, so you need four things, which is credit, income, assets, and then collateral. So credit, there's different requirements for different types of loans. Some lenders require as low as 580. Some will require 740. So it depends on the type of transaction that's needed. In terms of income, banks generally look at a 2-year history to qualify. W-2 income wage earners are always looked as the best. They're treated preferentially by all the lenders because it's easier to qualify. And if they're business owners, most of my clients actually are business owners, so it makes it more complicated because we have to look at their personal income and their business income and make sure it's continuously stable. So you have 2 years income. Generally, you want to make sure that everything is current, whether it be a 1 month recent pay stubs if they're W-2 wage earners, or if they're businesses, to make sure they get profit and losses to show the business are active. In terms of then the third pillar, so there's credit, you got income, assets. So it depends on how much is needed to put down for a down payment, or if it's a jumbo loan, sometimes lenders require 12 months post closing, after the down payment and closing costs, that they have enough.
It looks like we lost him for a second there. Let's give him a second to come back with us. I see people are asking questions. So what I would love for you to do is to keep popping questions in there. We're going to get to some more of your questions that are coming through so everybody could hear answers to them. But, Michael, why don't we go to one of the questions that came up from forming an LLC? What are the cons, if any, in purchasing through an LLC?
I would say one of the major disadvantages would probably be higher interest rate than perhaps if you were to purchase individually. Obviously, again, something to discuss with your lender at that time, but in general, the rates may be a little higher. You are not eligible for certain personal deductions on your mortgage that you would get otherwise. There are tax deductions for an LLC, but you don't benefit from the individual tax deductions. And although we had noted before, it is fairly easy to set up an LLC, some people don't want the hassle on a yearly basis of maintaining an LLC. The costs involved with that, registering it, if you do have multiple members, sending out tax statements, income generating statements, all that stuff. So for some people, the hassle isn't worth it as well.
Thank you. Ellie, sorry you got cut off there, but please keep going. That was important information you were giving.
Oh, yeah. So I was just, there were four pillars, as we said, like the legs of a table, and that was credit, income, assets, and then the collateral, which is, it's very relevant in New York City and Brooklyn because the buildings have to meet the lenders' minimum requirements. And the question is, why do the banks care about buildings? How many units are owner occupied, or what their level of insurance is, or any litigation? The reason is because they found statistically throughout, let's say 100 years, there's a larger level of default for buildings that could potentially go in disarray if something were to happen. So for example, if the boiler breaks and there's no reserve study, there's no reserve, 10% of the cost of maintenance, there's not enough of a reserve. It's going to end up being charged to the actual occupants or the owners of the units. And if they don't have the money, they're going to say, sorry, lender, sorry, building, I don't have the money. That so it causes what happens is disarray, and that it's a trickle effect. And owner occupancy generally, people will take care of their stuff better than if there's an investor. So if there's a larger investor, the building will naturally look less appealing. And litigation, like if there is litigation, people see in New York City all the time, it could be affect the building from people living there. Litigation is serious about the most important thing about litigation is if it's structural. If there's a question that the structural is there's an issue. Imagine, God forbid, we don't hear about these things in Florida in the condo building. If there was an issue that litigation of structural, you can imagine why it would be important for a lender, because any loans that were a friend of mine actually is a lender. He did a loan in that building and they don't even know what to do. It's like, so it doesn't happen. But what happens if there's structural issues, the lenders face a very, very large exposure to default if there was an issue with the building. So that's very important about making sure the building itself is approvable according to the lender's guidelines, but also collateral includes like appraisal. Banks are required to do an appraisal, not just for the heck of it to put in their system, but actually because if they had to default on the unit or house, they would be able to get back their money. If they didn't have an appraisal, then they wouldn't know if they're going to be able to get back their money. 97% of the time, I would say, the appraisals come in at purchase price. It's a magical wand. It's not like a random guess. The actual appraisers have a contract of sale and they have the application and they know where they need to get. If we're in a very hot market and it's cash buyers going up above and beyond what they know the normal trend or what the values are, and they know they're overpaying, there's times that the appraisal won't come in.
Mm-hmm.
But it's generally, they do come in. But if there's issues, for example, in the collateral, if there are things that are causing health hazard, for example, mold, or if there's open flooring or ceiling or random stuff, doors are knocked down, or even now, by the way, with regards to Hurricane Ira, there's now certain remedies that have to be signed in order to verify that even post an appraisal inspection, appraisal report, that the damage wasn't done, and if there was damage, then they basically waive their responsibility. It gives like the lenders an out. So things are important for the collateral, and those are the four legs in a nutshell. There's obviously deeper levels of credit, levels of income, and someone actually asked on the chat with regards to, somebody was asking something, question answer. Are you able on Social Security, if you receive a pension or Social Security, would this work against you? No, not at all. Actually, the banks are not allowed to discourage people from borrowing as long as they have documentable income and they could show their income over the last 2 years, they're going to be able to use it. So someone just started receiving their Social Security income. They showed their Social Security award letter for, let's say, 2021, and they show how much they're making from it. A lot of times it's not taxable, and you can actually gross up the income, which means like counted as that's like 120%, depending on the type. But we would generally show 3 months proof of receipt and the Social Security award letter. But it's definitely used. Pensions are used. It's a great thing, and definitely won't work against the person if they're like retired. I've done loans for I think a 98-year-old. It was treacherous because they didn't even have email; they only had faxes. But yeah, they don't. We'll take loans from anybody.
All right, but you were able to do it even through fax. That's terrific. I love it.
Actually, the most recent old lady, I love old people, but it was difficult because she actually didn't even have fax. I had to pick up every single document from her and scan and then give it back. It was just not fun.
All right, but you did it.
But I'll do it. I'll do it.
Terrific.
Listen, if that means to get me the 60 loans a month, to get that lady, I'm willing to do it. Yeah.
Excellent. Michael, how can a homeowner save on mortgage tax through a SEMA, and what is that process? And maybe you can explain what that is, please.
Sure. For those who aren't familiar, mortgage recording tax is a tax that's assessed on all home buyers of real property in New York when they obtain a mortgage. When I say real property, this applies to, again, houses, townhouses, condos. It does not apply to co-ops, Co-ops are not considered real property. You're technically buying shares of a corporation. So mortgage recording tax, for my answer here, does not apply to a co-op. But with a condo or a townhouse, at the time of your closing, you're required to pay a mortgage recording tax for all mortgages in New York. Lenders require this, and they can't record the mortgage against the property without paying that amount to New York State. The reason they want to record the mortgage, they want the public to be on notice that there's a mortgage against the apartment or the property, so that the owner can't just go sell it to a buyer who's not aware of the mortgage. But New York State collects money at the time of closing, and they say, okay, you're closing on your mortgage. At the time of closing, you need to pay a percentage of your loan amount to New York State. So in New York and Brooklyn, the 5 boroughs of New York and Brooklyn, that amount, the mortgage recording tax, is 1.8% of your loan amount if your loan is for $500,000 or less. If your loan is for more than $500,000, the mortgage recording tax is 1.925%. So that's obviously quite a hefty amount that you're required to pay in ancillary fees at the time of closing. So something that not all buyers are aware of, and it's really a savvy way to cut down on your closing costs and save, is an assignment of mortgage through a SEMA. And so an ASEMA stands for a consolidation, extension, and modification agreement. The idea is that if your seller, when they purchased their property, paid a mortgage recording tax and they have a loan still on their property, you can assign the equity left on their mortgage to your new lender. And so you save on that amount, and you only have to pay mortgage recording tax on the difference. So an example would be, I'm buying an apartment for $1 million. It just so happens that the seller of the apartment, the owner, has a mortgage for $600,000. They've already paid a mortgage recording tax on that amount. So I'm going to do an assignment of mortgage of their $600,000. I'm taking out a loan for $1 million, so I'm only responsible for the difference, which is the $400,000, paying mortgage recording tax on that amount. And that's could be anywhere from a $10,000 to $15,000 savings right there alone. So a lot of buyers aren't aware of it. It's a great thing to request. I will say, when I represent sellers, oftentimes sellers say, well, I paid the initial mortgage recording tax that you're now getting the benefit of on that $600,000. Let's split your savings. I'll allow you to do the assignment of mortgage. Let's split your savings 50-50. That's pretty standard in the market right now. And oftentimes I'll say to a buyer, let's look at the associated costs of doing the assignment, because you do need to pay, a couple of $1,000s to the bank to move forward with an assignment of mortgage. But your savings, even in splitting them 50-50 with the seller, are often worth it. So it is something to look for on a condo or townhouse or house purchase if the seller does have any equity left, a mortgage left on the property. And then as part of the contract negotiation or even the bidding process, you can ask to have it assigned. And the last note I'll say is that there are some lenders who are not so keen on doing assignments of mortgage. Some of the larger lenders who maybe aren't as familiar with the process in New York and do a nationwide market just frown upon it. So it is something, when you're getting pre-approved for your mortgage and you do see that your seller has a loan, you might want to say to your lender, hey, does this bank do assignments of mortgage? That is something I want to utilize. Because like I said, you could save tens of thousands of dollars.
That's terrific information. Yeah, thank you so much for sharing. I mean, as a buyer, I don't know why you wouldn't want to try to pursue that, right?
Absolutely. As long as it doesn't, you would make sure it doesn't delay the closing process. If you're in a really tight time frame, it can sometimes take a couple of months, but otherwise there's no reason not to pursue it.
That's terrific. Yeah, thank you, Michael.
Yep.
So I want to just express to everyone again, please pop questions into the Q&A and chat if you have any specific questions. Everyone's here to answer them. There's one question here that I want to bring up, I think to all three of you, because I feel like we also, Ellie, didn't touch base on something that's important. And really the question is, how much time should you allow for the entire process from making a bid to the closing? And what I was thinking of also, in addition to this question, is really knowing that your financing is in place before you start shopping. So why don't I just open it up to the three of you, maybe just to touch base in terms of time frame and process.
Sure. So I think before jumping in specific timeframes, and I'm sure that three of us agree on this, the importance of having a good team and good professionals guiding you through the process can make or break a deal. And it's the first thing we say to our clients. Most buyers maybe haven't had any experience in real estate, or it's the first time buying. It's going to be likely your biggest investment or one of their biggest investments. Recommending our clients to good attorneys, like Michael, good loan officers like Eli, who are going to go out of their way to just make it an efficient and an easy process, I think is the number one recommendation that we could do, regardless of how much time it will take, or it's just an efficient way of doing it. Specifically for us, on the broker side, I'm sorry to jump it onto Eli, but it's going to depend on the financing most of the time. That's going to take the longest chunk of money, the longest chunk of time. So I'm going to say realistically, from the minute you have an offer accepted, anyway between 45 and 60 days is what we try to accomplish. But it's really not up to us on the broker end to kind of control that timing.
Yeah, just to jump in on that, specifically to condominium and co-op apartments, I would say sometimes the time frame might be slightly longer because you're dealing with a board application, which Nicole would help you with, and potentially a board interview in the case of a co-op. Co-ops don't meet all the time during the pandemic. People are in various places. You have to do it by Zoom. So specific to a condo or co-op apartment, that's a rough time frame. I like to say maybe 60 to 90 days for the whole transaction, just to keep in mind that the board process can take a few weeks.
And also something we always say to our clients, if you're renting, don't give up your apartment in that time frame. Don't be homeless, because it's always going to be very tight. So if we say 60 to 90, give yourself 100 days. Give yourself, that extra cushion, which is hard to sometimes manage, but it's just, there's too many parties involved, and whatever estimate we're giving you right now, it has to be taken with a grain of salt.
One thing I would say to address what you said, Nicole, about one of the biggest things is the financing. Because as much as people say they're going to offer cash for units in Manhattan, there's statistics, I think over 90% people go for financing, whether it be in the initial stages on the purchase or sometime later, or delayed financing. So most people do get financing. And what I offer my brokerage community and my referral partners is that I do basically a commitment before the loan, before they even go into to contract, which means that essentially they have a commitment and they're only going to need an appraisal, title, and insurance once they identify the property. And that gives you it almost is like a cash offer, because even cash offers are not really cash. They usually get financing. So we kind of give the advantage where you're basically, let's call it 3 weeks ahead of the game. So all we'll be waiting on is ordering the appraisal, which takes about 7 to 10 days. It happens to be appraisers are swamped because it's a high volume, but it generally takes 1 to 2 weeks from the time of inspection. The building approval generally will look up front. We'll make sure that the building is good to go. And regarding title, generally there's no issues on title. And if there is, that's one of the few things. And homeowners insurance in general, condos or single family homes. So those things are just very minuscule in the larger spectrum. We vet the income, the credit, and the assets very, very diligently to make sure that they all qualify. Once a person has a commitment, it's essentially a done deal. So that's what we do to create assurance. Anyone who doesn't want to run their credit or get fully vetted, they're not really serious, and they're not going to pan out. I like to give the assurity. I call myself like a mortgage doctor. I prescribe what they need to do in order to have have a healthy mortgage. And if they don't listen, then they're not going to be able to close. The people that want to shop 6 different banks, they're not going to get if they want to close efficiently and they know the surety to close. That's why they come to me. So that's what I kind of offer to take the advantage. And when it comes to buildings and different issues, I've never seen anyone that was not able to get through. If there's anyone else that could do it, then I'll be able to. So those different issues that would arise, generally would vet it prior to, and that's what I do as a lender. I think anyone who's a lender who's just like working in a bank and just does it according to the schedule of the bank is just not doing a service for the clients and for the brokerage community.
And that's why also, just to stress on this, I cannot say it enough, this is going to be your team, right? Your broker, your loan officer, and your attorney. And having good professionals and good people who are, each one of us is going to look out for different interests in that transaction, right? I'm going to want to get the deal done. Michael's going to make sure that due diligence is properly and very detailedly done. Eli is going to make sure that you get, the best product possible. So again, having qualified professionals guiding you through the process is going to make a huge difference.
Nicole, let's go back to, your company, NestApple's offering of rebates, because I want to make sure that everyone, understands, A, why you offer them, and B, is this a structure that is even, I guess, permissible in New York City right now?
Sure. So let me start with the latter. Real estate rebates are not only legal, but they are encouraged by the local authorities to promote transactions. Okay. And the reason we came up with this concept, which again, I'm not reinventing the wheel here, it's just a matter of efficiency and bringing real estate to the 21st century. Okay. Let's take it back 30 years when there was no internet. Brokers had to send telegrams and faxes and gather listings manually, deliver them manually to their clients. And it was a different era. Nowadays, we have inventory on our screens. Buyers know what they want. Buyers know what they can afford, what they like. And it just makes sense to bring the fee structure, which has been 6% for decades in New York, to just modern times. So the only thing we're offering differently, it's not a different type of service. I'm offering you a full brokerage service. We're just offering for a fraction of the price because you as a buyer are qualified enough and have all of the availability and all of the options available, with the touch of your finger. So it's just a way to modernize the way real estate is done in New York.
Ellie, I have to imagine that a big part of what's driving the market now is interest rates. Can you touch on where interest rates are now and what you think is going to happen over the next year or two?
Good question, Josh. I tell people rates are at 1%. Or rates are, no, really 5%. Well, if you do 1%, you're paying 300 points or whatever it is. You're paying 5, and you do 5%, you're getting 300 points back as a credit. So the reason why I respond that way is because there's a large gamut of different options, and it's based on the type of property. Every rate is assigned to a specific property. Without having the specific property type or the specific type of program, it's impossible to actually give the proper rate. I could tell you the rates are 2.5%, but it may not be relevant. And I'm not trying to be difficult. I'm just trying to give you a perspective that there's the world that the world's at your fingertips in terms of interest rates. And yes, I've done very well, thank God, because of having interest rates where a lot of clients, existing clients, over the last 10 years have refinanced their mortgage when they were at 3.5%, and they went to 2.5%. So that's a huge volume that the business created as a result of lower interest rates. And yes, it makes more people actually qualified, because the lower the interest rates, if someone has $1 million mortgage and they're saving 1% and their payments go down $800 something a month of interest savings, they can make about $18,000 less of income or $20,000 less of income on an annual basis and still qualify for the same mortgage. So they end up being able to qualify for more of a mortgage. So more people are able to enter the market. What I think when it comes to interest rates, I don't think that's the reason why people are buying, really, or even if they could qualify. In New York, most co-ops won't even look at a buyer if they don't have the debt to income ratio under 35%, which means well below what the banks actually allow. The co-ops have restrictions. Even condos have restrictions. Many times I've literally cleared to close, and what happened was the building didn't approve them for X, Y, and Z. So many times the lenders are the ones that are restricted, but the buildings are. So when you talk about interest rates being able to qualify in New York, it's not as much of a factor. But definitely people get excited when the payments are less. I get excited. But at the end of the day, people will buy homes regardless of the interest rate, as much as they want to breathe the air. They want something, they're gonna go get it. If if the milk costs $1 or $1.50 or $2 or $2.50 or $3, you're still going to want milk. So it's something that's a utility. I think most people don't want to rent for the rest of their lives. They want to have the American dream, quote unquote. They want to live with their family. They want to do work and not pay a landlord. So if that's the case, then it doesn't really matter what the interest rates. And obviously, I'm a proponent. I'm a mortgage counselor. I counsel people on how to get the best rates. But it's not the number one factor, because if that is, then you could just pay $300,000 in points and just get the lowest rate, get 0%. But that's not what the person ultimately looking to buy the property and get in. And obviously, once you're there, to pay as low as possible. But there's a lot of different options when it comes to different rates. But I don't mean to push you off in terms of the different options. You know, I would say 2.75, 2.875. It depends. You know, it could be 2.25, 15-year, or maybe 2%. But you know, it's worth the question. It's a good question, and it's also worth the inquiry. You know, what they're looking for, what they have. So essentially, the everything is an option. You know.
Michael, I'd love for you to address title insurance, both what it is and whether it's necessary when making a purchase.
Sure, absolutely. So to start with, title actually means it's basically the right to own and use a piece of property. So title insurance makes sure that you're actually buying the property free and clear of any liens, judgments, mortgages at the time of your closing. So what typically happens is once you enter into a contract, your attorney, we would order what's called a title report. Title report searches the property, the buyer, and the seller for liens, violations, judgments, open mortgages, etc. And at the time of closing, you actually buy a title insurance policy, which is a policy against any defects in title for future claims that you were not aware of at the time of your closing. So for example, if you close on your property and 10 years later, somebody comes out of the woodwork and says, actually, I was a prior owner, and in the chain of title, I was excluded accidentally. I had a right to sell to you, and I have a right to part of the proceeds. Your title insurance policy would cover that. Same thing goes if there was fraud and the seller who sold you the property wasn't actually the true owner. There was an issue with inheritance or divorce in the chain of title. If any back taxes are owed from before you became the owner, any open mortgages, things like that, liens that you're not aware of. So title insurance is a one-time fee that you pay at the time of closing. Generally costs between about 0.4 and 0.5% of the purchase price. The exact amount depends on the purchase price and whether you're getting financing, but it is a one-time fee and it does cover you for the life of your ownership. So a week after you close or 20 years after you close, somebody comes to you with a title claim, you have your insurance policy, you're covered for the life of your ownership. It is something I always recommend and insist on buyers who are paying cash. It's worth it. If you are getting financing, lenders often will not lend to you without a loan policy and title insurance policy. They're investing in you and the property. They're giving you a loan against the premises. They want to make sure everything's clean as well. So it's rare to find a lender that would forego it as well. And one other thing to note is when you do eventually sell your house, your buyer will be getting a title insurance. And if there are issues there and you don't have a title policy for when you bought, you might have a difficult time clearing up all those issues so you can properly sell to your buyer. However, if you do have a title policy, you can provide that to the incoming buyer and title company, and it should provide you coverage. Last thing I'll say is title insurance and a title report, again, does not apply to a co-op. A co-op, it's not real property, you're buying shares. You run what's called a lien search, which looks at the co-op building, the buyer, the seller, for open liens, mortgages, judgments, etc. However, that to run a lien search, it's about $350, very cheap, and you're not buying a policy at the time of closing. There can only be one owner of stocks and shares to a unit, and the seller at closing, their stock and lease is canceled, and a new owner's stock and lease is delivered, and there's never a question of title. So just keep in mind, it's not applicable to co-ops.
Very good information. Ellie, another question on financing. Is mortgage insurance required with down payments of less than 20%?
depends on the transaction as well. Generally in the jumbo lending space, there's up to, let's call it $2 million. There's 90% financing without mortgage insurance. So if that is available. It used to be that I used to do like a 80% first mortgage and then 10% line of credit. Generally, the lines of credit are much worse interest rates. So it's better to probably get 90% straight financing. That's what I've been doing. And there's no mortgage insurance. Generally, it's baked, call it baked into the rate. So the rate generally gets adjusted as a result of a higher risk because of the higher loan to value, less money out of pocket. And the mortgage insurance is not paid separately. It's paid as part of the rate. So generally there is a bump in the rate, but if that's what a person wants, a lot of times if it's a $2 million property, paying, let's say to get a solid rate, paying 1% is worth it rather than paying 10% additional down payment. So they end up benefiting. They could always refinance, and there's no prepayment penalty, they call it in the commercial real estate world, like there's some commercial mortgages. So it's there is generally mortgage insurance though, so it depends on the type of transaction. For loan amounts of 822 and below, which is the maximum conforming limits in New York, that is generally there will be mortgage insurance unless you do lender paid mortgage insurance, which again will increase the interest rate, but it will end up it would increase the interest rate if you did as a lender paid credit. Generally, if a person's not planning on staying as property for probably 5 or 7 years, historically people don't stay in one mortgage. Everyone has ADD. After 7 years, that ADD expiration goes. So that's part of the reason why 30-year fixed could be at such low interest rates, because they know that people are not going to hold on to the mortgages for 30 years, just like 7 years max on average. So therefore, and especially in New York, when it's much more of a transient area. So for those, you have to really do a calculation if it's worth doing a lender credit to instead of paying the mortgage insurance, because if you're not there for so long, sometimes it's better to just pay get a lower interest rate and pay the mortgage insurance premium. If you're there for a longer, then it could be that if you're going to have a mortgage insurance for a longer period of time, it will end up being more advantageous to pay a higher interest rate. But it's all based on a calculation of based on how long a client, borrower will want to stay in that with that mortgage. I've had basically virtually all my clients that I had from the beginning, well, it was 9-10 years ago, either they upgraded or they refinanced. So it's almost never, even my parents, and they refinance, and they went to a 15-year. Anytime you refinance, you lose any points. So for them, if they were paying, taking a higher rate, it may have made sense, but it would depend on kind of their risk horizon of the amount of time that they're going to be holding on to the mortgage.
Well,
So it's a math calculation.
It sounds like to me that, each participant listening really needs to have a conversation with you on their personal finances, the type of transaction they're looking for to really hone in on what you think is best for them.
Well, only if they want to get a mortgage, that they'll want to come to me.
Right.
If they want me to help them with their, building up their credit or applying to American Express, I don't know how much I could be of help. My brother does, airline miles. Maybe I could refer him, but generally, yeah, if they want to get a mortgage and they're motivated, I'll be able to help them. I don't charge for my speech. I wish I did, because I make a lot of money. But if people have any questions, I don't charge. I'm very nice. I don't bite, especially through the phone. And they could always ask me any questions that they may have.
We have a few more questions here in the Q&A, but I have a couple more questions left over from Michael, and then it looks like people are hanging out here, and depending if our panelists have time, we can hop on these. But Michael, what is the 2 out of 5 rule, and how can a buyer or seller benefit from it?
Right. So I'm sure people have heard the term before, capital gains tax. Capital gains are pretty much defined as the profits that you make as a result of your real estate transaction. So you could think of it as the difference between what you purchased the property for and what you're selling the property for, and there would be taxes paid on those gains. Your capital gains depends on various numbers and conditions. There are deductions that are made available, such as your closing costs, loan application fees, etc. However, generally speaking, in New York State, you pay about roughly 15% of whatever your gain is in capital gains tax. And if your property is in New York City, one of the 5 boroughs, there's an additional roughly, I believe, 5 to 10% on top of that. So in terms of the 205 rule you were asking about, if the premises that you're selling was your primary residence for at least 2 of the last 5 years before you close and sell on that property, you're eligible for certain deductions on your capital gains tax, which could be quite beneficial. This exclusion, if the property was your primary residence for 2 of the last 5 years, is up to $250,000. For the first $250,000 are excluded under capital gains for an individual, and $500,000 exclusion for a married couple. So for a property to qualify as that, you have to actually have lived there for 2 of the last 5 years. A vacation house, for example, would not apply. So there are benefits if you are thinking of selling to make sure that you do qualify and you have lived for at least 2 of the last 5 years so you could reap the benefits here. One thing to note is you can't have this exclusion, this benefit of 2 of the last 5 years if you've taken this exclusion elsewhere in the last two years on another property. And the last thing I'll say is in terms of when capital gains tax are applicable, when they're paid. If you're a New York resident, you pay them when you file your taxes. So if you sell this summer, next year, next spring, when you file your taxes with your accountant, that's when the capital gains tax will be due. If you're an out-of-state seller, you live in Nebraska full-time, but you own a property in New York City and you're selling that property, the capital gains tax is actually paid at the time of closing. An estimated capital gains tax is paid by an out-of-state seller at closing, not when you file your taxes. The one way around this, if you are an out-of-state seller and you have actually, even though you're not a New York resident or taxpayer, you did live in the unit for 2 of your last 5 years, then again, you can simply pay the capital gains at the time you file your taxes as opposed to at the time of closing.
Well, let's talk about, staying on the topic of taxes, what a 1031 exchange is.
Okay. Yes. So 1031 exchange, not so many people are familiar with this, but it applies exclusively to investment properties. So what I'm about to say, it does not apply to your primary residence or home or vacation home. It's simply for properties that you use for business purposes, investment purposes, and you never actually live or step foot in. There's a section of the U.S. tax code, it's IRC section 1031, which is where the name 1031 exchange comes from, that enables certain investors to defer the capital gains tax that would be payable on an investment property at the time of closing. So first, the property that you're selling, you could have never lived there. It has to have an income generating property, and the property you're going to use with the proceeds of your sale also has to go towards purchase of an investment property. The idea is at the time of your sale of your investment property, the proceeds from the sale go to a qualified intermediary, a 1031 exchange company who handles this on your behalf. This QI, qualified intermediary, holds the money and never touches your hands, the seller. And then you, within 45 days of the closing, need to send to them a list of potential properties that you're looking to buy. And then within 180 days of your closing, you actually need to close on that purchase. And you would use those funds that a 1031 company is holding to buy that property. And so the capital gains tax is deferred. You don't pay capital gains, you push it down the line. You could keep doing it over and over, 1031 exchanges, and you wouldn't have to pay the capital gains at any point. Any funds, though, you don't use for your purchase of an investment property, those would be subject to capital gains tax. And although your gains are deferred, eventually, if you use the money for a reason other than buying an investment property, you will eventually pay capital gains tax down the line. And the last thing I'll say is that, there are time limits associated with this. It's always beneficial to get in touch with a professional 1031 company who would be holding your funds. There are one or two that we use, we trust all the time. They send you calendar invites, dates, they're on top of everything. So, your attorney or broker or banker could help you with this information, but it's not something, the process you don't have to do on your own. There is a company that holds your hand along the way and makes it easy.
Yeah, I mean, I could just tell the audience, you're talking about saving a tremendous amount of money by utilizing a 1031. It's certainly something that you need, attorney like Michael to help with.
Right.
I know there were some other questions there. I think we've gone over, but we will be emailing Nicole, Michael, and Ellie's information to all of you. They are here to answer your questions after the fact, so please do reach out to them. I want to thank all three of you for participating and really giving terrific information to our audience. And I want to thank our audience who almost all of you stayed on the entire time, which we appreciate. It's great information. It's free information that they're here to give. And please make sure to reach out to them. And I think, Nicole said it, and I'll reiterate it. You really have to have a team in place. And obviously, the three of them have done this for many years and really know what they're doing. So I just want to thank you all for being here, and have a great afternoon.
Just sorry to interrupt. We have had a great year, and I'm actually recruiting. So if there's any brokers out there who are interested, please get our contact info and please reach out.
I love it. Well, thank you again, everyone. Look forward to
Thank you, Josh.
being in touch. Take care. Have a great afternoon. Thank you.
Bye.
Take care. Bye.